Hey, it's Brian Cushing, your Mortgage Insider, here to bring you a little insights into the current geopolitical landscape and what that really means in the mortgage world. 2022 was already planned to be a year of rising interest rates, and then the first 65 days of the year, we already saw them go as high as the rates had even been projected for the whole year. So I want to go into a little bit of details about why that is and really what's the future going to hold. I like to share the screen so you can see a little bit of detail. So this was something I just thought I would share. Forward-looking bear stocks and stocks tend to foreshadow recessions. So this last week, the Dow Jones Industrial, the S&P 500 have all hit a pullback, right? They've hit a 10% or more pullback in their total market valuations, and this takes us back way back in history when the S&P 500 index or the federal funds target rates, if you watch, rates going up, that caused a recession back in, say, the 70s. Rates were really high back in the 80s. This is part of the conversation right now. The Federal Reserve is going to raise the short-term interest rate. Typically not great for the economy, but it could be very necessary to combat inflation. Most recently, though, we saw the steady increase in rates from the 2015 to 2019 era. And then a recession shortly followed after that. It was very small. That was the recession of 2020 due to COVID. So one of the precursors to any recession, if we look back in history, this particular chart, I just went back 20 years for simplicity. This is the spread between the 10-year and the 2-year interest. This is the government's interest rate that they pay on their debt. The 10-year treasuries typically have a much higher. So right here is a 2.58% difference between the 10-year note and the 2-year note. So when the two squeeze or get inverted, they call an inverted yield curve, shortly after a recession typically hits. So we did see that in 2019, August 2019, a small inversion of the yield curve ultimately resulted in a recession. But who would have thought when this happened that there would be a recession due to COVID-19, right? That was not really part of the game plan, but these charts are very interesting how they play out in the long run. So the reason I bring this up, we are currently slowly getting closer and closer to an inverted yield curve. So with that, just go to a market overview for the day. We continue to see the slide with stock markets. Today, the S&P 500 does appear to be back up a little bit, but if we wanted to just take a look at the time period here, over the last number of months, the S&P 500 fell from its highs at the beginning of the year, December 28th, into January, and it has officially gone below 10% turnaround. We saw the market come back up. We saw it drop significantly yesterday. It's now Tuesday. Just huge volatility. And go figure, that's on the heels of all the Russian and Ukrainian news. So what does that have to do with rates? Well, oil. I think that's really the biggest thing. The increase in oil costs is going to increase the inflationary pressures throughout the economy. That will drive rates up. We've seen rates moving this year. If we took the same time period from early January, 10-year Treasury yields had gone up. They settled down a little bit. They went up even further. The only thing that really knocked them off was the middle of February when we started hearing more and more, and then ultimately the Ukrainian invasion by Russia took place. Drops and rises, drops, rises. It's back and forth. Really, the big deal here is that economies are all over the world are trying to figure out how does this play out for their economy. In the U.S., we want it to not cause a recession, but if gas prices go up right as the summer hits, we're talking about highs in the oil market of the highest since 2008. 2008 was a pretty big recession, so this could be a pretty big deal for all of our pocketbooks. It does make a difference when it comes to decisions when people make to buy homes. Mortgage rates for sure will impact that decision. But if you really need housing, if the interest rate goes up from 3 to say 4%, that's still a pretty good rate historically. If they go much higher than that, that's when we'll start to see a lot of pressure. 2019 was the last time we saw rates significantly higher than 4%. They were close to 5% at the end of 2018, just for a point of reference. So with that, if you have any questions, we'd love to stay in touch. We are your mortgage insiders. Give us a call. We'd love to catch up. Take care.